You deposit $1,000 into your bank account on Monday morning. By Monday afternoon, someone across town signs a loan agreement and the bank hands them money, your money. That's the version of banking most people carry around in their heads. It's clean, it's simple, and it's almost entirely wrong. Banks do not take your deposit, walk it down the hall, and lend it to someone else. That model, the one taught in most introductory economics courses, repeated in newspapers and referenced by politicians, describes a system that doesn't exist. What actually happens inside a bank when a loan is made is so different from this story that when the Bank of England published a paper explaining it in 2014, it barely made the news, which tells you something about how comfortable the world is with the version it already believes. So here's what actually happens. When a bank approves a loan, say a mortgage for $300,000, it doesn't check a vault. It doesn't scan its deposit base. It doesn't shuffle money from your savings account into someone else's. The bank creates the money. Not metaphorically, literally. It types a number into the borrower's account, and that number becomes a new deposit that didn't exist 5 minutes ago. The loan creates the deposit, not the other way around. This is not a fringe theory. This is the operational reality described by central banks themselves. The Bank of England's 2014 quarterly bulletin said it plainly. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Federal Reserve's own documentation supports the same mechanics. Money in the modern banking system is not a fixed supply being passed around. It is manufactured on demand every time a loan is issued. Now sit with that for a second, because it breaks a lot of assumptions. If banks create money when they lend, then your deposit isn't the raw material, it's not the fuel. So what is it? Your deposit is a liability on the bank's balance sheet. It's what the bank owes you. When you deposit $1,000, the bank doesn't receive money the way you'd hand cash to a friend. It records an obligation, a promise to give you that money back when you ask. In exchange, the bank gains a reserve asset or the use of your funds in settlement. But the lending? That runs on a completely different engine. This means the textbook model, where banks collect deposits, hold some in reserve, and lend out the rest, is backwards. It's called the loanable funds model, and it has shaped how millions of people understand money. The problem is, it describes a system from the 1800s, maybe. In the modern financial system, loans come first, deposits follow. Banks are not middlemen, they are money creators with a license and a balance sheet. Here's where it gets uncomfortable. If banks create money by lending, then the money supply of an entire economy is not controlled by savers or the government printing bills. It's controlled in large part by the lending decisions of private commercial banks. When banks feel confident, they lend more. More loans mean more money in circulation. When banks get nervous, say during a financial crisis, they pull back. Fewer loans, less money. The economy contracts. Not because people stopped saving, but because banks stopped creating. During the 2008 financial crisis, this mechanic played out in real time. Central banks slashed interest rates, governments pushed stimulus, but bank lending froze. And without new lending, the money creation engine stalled. The Federal Reserve eventually had to step in with quantitative easing, buying assets directly, just to inject liquidity into a system that private banks had stopped fueling. The money printer everyone jokes about? It was a backup generator for the real machine, which had already shut down. This also explains something most people find confusing. How can there be so much debt in the world? Global debt is now north of $300 trillion. That number sounds absurd until you understand that in this system, money is debt. Every dollar in your bank account exists because someone, somewhere, borrowed it into existence. If every loan on Earth were repaid tomorrow, the money supply wouldn't just shrink, it would vanish. there would be almost no money left. Debt is not a side effect of the system. It is the system. And your deposit? It's still sitting in your account. You can still withdraw it, spend it, transfer it. But the bank didn't need it to make that mortgage happen. Your deposit helps the bank manage reserves, meet regulatory requirements, and settle transactions between banks. It's useful. It's just not what you think it is. So the question nobody seems to want to ask out loud is this: if private banks control the creation of money, and the amount of money in the economy depends on how much they're willing to lend, then who actually runs monetary policy? Central banks set interest rates, sure, they adjust incentives, but the decision to create money, the actual act, happens at the loan officer's desk, not in a government building, not in a democratic process, in a conference room based on risk appetite, profit targets, and quarterly earnings pressure. We built the modern economy on a system where money is willed into existence by institutions whose primary obligation is to their shareholders, and most people still think the bank just lent out their savings. Maybe the more uncomfortable question isn't how this works, it's why so few people are told.